In the last 12 months, Alphabet stock has more than doubled. Amazon is up about a third. Big tech has added trillions of dollars in market value in just 1 year. And if you own an S&P 500 index fund, a 401k, or any retirement account in America, you're sitting on a piece of it whether you want it be or not. Last week, Amazon and Alphabet manufactured $45 billion of profit between them without selling a single thing. In the same quarter, their actual cash collapsed 95%. This is what an AI bubble actually looks like from inside their balance sheet. And we have seen this before. We called it the dot-com bubble. So today, we're breaking down how Amazon pulled this off, why is it all perfectly legal, and how scarily similar it looked like to what took down Lucent Technology, the dot-com bubble's most spectacular collapse. To show you how this works, we have to start at a private AI lab in San Francisco called Anthropic, and a single funding round in February that just got Amazon to manufacture half of its profit out of thin air. On February 12th of this year, Anthropic raised $30 billion at $380 billion valuation. And that one round is the entire reason Amazon's earnings looked the way they did last Wednesday. Which sounds weird because Anthropic doesn't sell Amazon products and they don't send Amazon a single dollar. So how does Anthropic's funding round end up as half of Amazon's profit? You might be thinking, wait, that's not how earning works. Well, since 2018, not exactly. The accounting rule that changed everything is called FASB ASU 2016-01. That's a mouthful. It says that if you own a stake in a private company, every quarter you have to mark it to whatever the latest funding round implies. Even if you don't sell a single share, even if not a dollar of cash moves, the change in value flows straight into your income statement as profit or loss. Amazon has been investing in Anthropic since 2023, about $8 billion in total. When Anthropic raised in February at $380 billion, Amazon's $8 billion got remeasured at over 70. The difference, $16.8 billion. That's the line buried in Amazon's earnings release. Pre-tax gain of $16.8 billion from our investments in Anthropic. More than half of Amazon's entire pre-tax profit for the quarter. Strip out the mark, and Amazon's actual operating business made $24 billion. Still good, but not exactly headline worthy. Because while reported profit nearly doubled, Amazon's free cash flow, the actual money coming through the door, collapsed 95%, from around $25 billion last year to barely $1 billion this year. That's less than they spent on capex in 3 days of Q1. The cash machine that built Amazon is being redirected almost entirely into AI infrastructure, roughly $200 billion in capex this year alone. The Anthropic markup filled the gap on the income statement. It does not fill the gap on the cash flow statement. And here is where it gets uncomfortable. The same week Amazon reported, Alphabet did the same thing, but bigger. About $28 billion of Alphabet's latest quarter profit come from marking up the same private companies, mainly Anthropic. And here's the part that really gets me. 6 days before the earnings, Google had just committed another $40 billion of fresh capital to Anthropic, which is itself the thing that pushes Anthropic's price higher, which then triggers Google's existing stake to be marked up, which then hits Google's earning as profit. The investor and the price setter are the same entity. Robert Willens, who taught accounting at Columbia Business School, told Fortune that they're able to control or influence the value of one of their own assets by engaging in business transaction with that entity. He's being polite. The plain English version is Google is funding Anthropic at a higher and higher price. And Google is booking the gain every time that price goes up. So is Amazon, and so are several other big tech investors. And before you ask, all of this is completely legal. its GAAP is audited, is disclosed. Which is what makes the next part of the story so interesting. Because what's even more scary, and we have seen this before, is what happened to a company called Lucent Technology the last time tech got this hot. In 1999, Lucent, the AT&T spin-off that built early internet equipment, had a problem. Their customers, mostly upstart telecom carriers, couldn't afford their gear, so Lucent started lending them the money. They used the loan to buy Lucent's equipment. Lucent booked the sale as revenue. Both numbers looked spectacular. Stocks soared. Then the customers went bankrupt. Lucent lost $250 billion in market value, about 2% of US GDP at the time, and never recovered. Cisco and Nortel were doing basically the same thing. Cisco stock still hadn't made it back to its 2000 peak 26 years later. The mechanic today is different on the surface. Equity stake marked to market, not loan booked as revenue, but the shape of the money is the same. The vendor's capital flows out to the customers growth gets marked up, the marked up flows back to the vendors as profit. Strip away the financial engineering and you can't actually tell how much of the demand is real. And what's happening today is bigger than 1999. The 4 big hyperscalers are spending $700 billion on AI infrastructure this year alone, roughly what the US government spends on Medicare, and cash flow at all 4 is collapsing. There's one detail I found in my research that I haven't seen anyone else cover. Anthropic is already in talks for the next round, near $900 billion. If that closes, Amazon and Google book another markup next quarter, bigger than the last. The loop tightens. So the thing I want to leave you with isn't really about Amazon or Google. Anthropic, by the way, is real. Fortune 100 customers, real revenue. The story isn't about Anthropic. The story is that big tech earnings, the one every financial shows on TV is calling a blowout, now are structurally dependent on a private AI company's valuation continuing to go up. The day Anthropic raises a flat round, a down round, or doesn't raise at all, that same markup runs as reverse, same shape, same magnitude, as Lucent's shareholders found out the hard way. So next time a big tech earnings call gets called crushing expectation, it might surprise you how much of that beat is sitting in a footnote on page 38 that no one is reading. Thank you so much for watching. If you're enjoying this video, make sure to give it a like and subscribe to the channel. It genuinely helps me out a lot. And if you want to research AI stocks faster and understand what actually matters without spending hours digging through the hype online, I've put together a free AI stock research cheat sheet for you guys. It will be linked down in the description below. That will be a little gift from me. Thanks again for watching, and I'll see you in the next one.